I don't have any words. Let's always start that way. What a lovely sound. What is that?
This is like a singing bowl. Someone gave this to me on my birthday.
I love it.
Yeah, you're supposed to like hold it in your palm and hit it and then like let the sound go.
Yeah.
And like basically hold it until it stops reverberating. It's like a somatic response or something.
Wow.
But it's very lovely. So there you go. Welcome.
There you go. Welcome to Talking Too Loud.
Welcome to Talking Too Loud with Chris Savage, the show that's serving up the loudest takes on building businesses, top-notch products, and unforgettable brands. I'm here with Eric Paley, managing partner at Founder Collective, a seed-stage venture capital fund backing transformative startups like Uber, Airtable, and Whoop. Eric, thanks for being here, buddy.
I'm excited to be here.
I'm excited to dive into the art and impact of investing with you. But first, this podcast is called Talking Too Loud because when I get excited, I cannot control the volume of my voice. And we have to start the show by asking our guests, what has them talking too loud? So what has you talking too loud today?
Yeah, I often talk too loud. But the primary thing I'm talking very loud about over time is just how incredibly toxic venture capital can be, how misunderstood its use is, and how much it ruins companies. So that gets me worked up, and I'm often talking way too loud about that.
Why can venture capital be so toxic?
Yeah, I mean, I think it starts with VCs. The only thing we have to offer really, or the primary thing we have to offer, is money. So we think money's like pixie dust. And for entrepreneurs, partially because you get so much rejection and it's so hard to get off the ground, when people want to give you money, it just feels like the greatest validation you could ever have. So you have this very weird formula where you have people who think they have the magic pixie dust, who are effectively act like drug dealers. And then you have people who find the validation of that pixie dust to be so validating, even though it has nothing to do with whether or not your customers are going to want what you have or you're building a model that works. It actually is not validation in any meaningful way. But that combination creates enormous problems. It gets me very worked up because we talk about after product market fit, the number one reason startups fail is bad capitalization. And rarely is it a lack of money. If you have product market fit and you're validating that in the market, it's actually too much money. So once something works, capital comes rushing at it without a lot of thoughtfulness, and then it can destroy it. In fact, it usually does.
Okay. This is obviously what I want to talk to you about, but I want to set the stage first for people who don't know. So like, you're a seed stage investor. How many investments have you done since you've been investing in the seed stage?
Me personally or Founder Collective?
But put them together.
So Founder Collective in 15 years has done about 300 investments. And I've probably done, 40% of those, maybe 35% of those.
And is there something that drew you to this stage in particular?
Well, I was a two-time entrepreneur. And I love the seed stage. There really wasn't much of a seed stage venture capital ecosystem when we started. There were really just a handful of funds. That's become institutionalized over the last 15 years. So now there's a very big stage, right, of institutional funds that do seed or do life cycle from seed. We're not a life cycle fund, so we really are a seed fund. But what drew me to it is I love the beginning. I love entrepreneurs at a stage where they're dreaming and they're learning and they're iterating with their customers. And I've been on boards all the way through many years as a public company, so it's not like I don't enjoy that later stages as well, but there's just something about the beginning because you can go in so many different directions, and if you're thoughtful and disciplined and you really listen to your customers, very often you can do some magical things.
When you're making those investments, you're looking at the seed stage, like how many of them do you think already have product market fit versus like you could just do rough percentages, and how many do you think are searching for it?
Yeah, I would say when we invest, almost none of them have product market fit. It's incredibly rare. Sometimes you see, one thing I've talked about over the years is product market fit is not this like singular moment in time. It's a spectrum. And what we really think of as product market fit is your customers are pulling something out of you. At the stage we invest at seed, that's almost never really what's happening. Every once in a while, you'll see some real clear signs of it. But what we're more interested in at the stage we're investing is how engaged is that founder with their customer? Why do they believe the customer is looking for this solution? How well do they understand the customer's problem? And how much have they learned already about how to attack that problem that has gotten them to what they believe this solution should be. So we're looking for all those ingredients, and then we're measuring that against how long have they been at it. So if they've been at it for 4 months, that doesn't mean we're not interested. That we're often very interested right from the start, but we have a different set of expectations than if they've been at it for 2 years, where we'd expect them to have put some product in market, to learn from their customer, unless it was something that was meaningfully harder tech.
Got it. And so you're kind of saying, let me just play this back. Like, you're looking for people over product market fit at this stage. You're looking for people who really understand a problem, a customer problem that they're trying to solve, and have some expertise, have shown that they have made progress in that space, have a reason why they believe that this solution that they're now on to raising money around is the solution to solve this big problem. And then you're taking a bet, basically, like, are they right? Like, will they actually get to product market fit?
Yeah, and the only thing I'd add to that, because I think that's all right, is two things. One is we really try not to use the word bet, because we don't actually like gambling metaphors for any of this. I think the idea here is to be
You don't like gambling?
Well, there's nothing wrong with gambling as entertainment. But we're asking entrepreneurs to be incredibly sophisticated about their own investing in what they're doing. And we want to make sure that we don't come off as glib, like we're just like placing a bet. We're not placing a bet, right? We are investing in somebody's plan and approach and thought process. We're investing in a company. Even if it's the very beginning of a company, we're investing in all of that. So that's one thing I would add. The second thing is it's very not static. So one of the things we're very interested in is their approach to building proof points, right? How do they think about how they're going to build this out over the next 3, 6, 12 months, 2 years, and into the future. So part of it is we're investing in their approach as well.
And then I also want to hit this before we get back to the overcapitalization point. But like, some of the you've invested in Uber, for example, and you invested very early. And obviously Uber raised a lot of money and grew to become like an unbelievable household name. Is there something about an investment like that that you saw that was like, in hindsight, was different, or hindsight was like some signal?
Yeah. So I'm going to be very candid about this. You know, I think there's a natural tendency among VCs to say, I knew it. There was something about this one. I knew it. And I think the truth is, we hope we're not making bad investments. We look for things that we think are really exciting things to us. And we hope that across the things we invest in, our batting average will be really high. Our slugging percentage, if we're going to use the analogy, will be really high. But if you ask me the 5 companies we invested in before Uber and the 5 companies we invested in after Uber, which one of those, I guess, 11 companies was going to be the outlier of that group, I don't know that we would have chosen Uber, right? I think it was very compelling. There were things about it that got us extremely excited. It was Ryan Graves who actually pitched us, not Travis. Travis wasn't actually full-time at the company at that point. And I had done some interesting things involving the taxi industry previously, so I really got excited about where they were trying to go. But we invested in several things that didn't make it right around that same time, and I wouldn't have been able to tell you that something about Uber was so different that it was going to be this huge outlier, and the other one would never make it. I couldn't have told you that.
You were hoping for something there, weren't you, Sylvie?
I was like, what's the hack? No.
Yeah, if I knew, I would do it every time.
Yeah.
Right?
Yeah.
And we've been lucky. We've had a lot of, well, maybe not a lot of Ubers, but a lot of extraordinary companies. We've had 3 companies that have become over $30 billion valued companies. So sort of in that incredibly rarefied air. But I couldn't have told you among the ones we've invested in. Again, we're investing because we believe, right? And so it's not a random pool of things, so hopefully it's a well-selected pool. But which ones would become the tens of billions in value? We couldn't have guessed that.
How do you learn to believe? Like, can you train that muscle?
Yeah, it's actually such a good question. I think we're looking to believe. Right, which may sound funny because we invest in whatever 1% to 2% of things that come in through high quality lead sources, and then a way even smaller percent if you include everything that comes our way. And so you might say, well, geez, if you say no that often, you're probably pretty cynical. And I would say it's the opposite. Like, we look at everything from the standpoint of okay, like how can we get our head around this becoming something really special? And a lot of that journey is about, do we see something really special in this entrepreneur? And often we're wrong, false positives and false negatives. But we've been pretty lucky to pick some great ones over time. And I often say to entrepreneurs when we invest, we've been very lucky to invest in some of the greatest entrepreneurs of this time period. And the things I saw in them, I see in you. That's why I'm investing in you. You may believe in yourself, but you probably still have trouble imagining that you can build something at that scale. And that's for good reason. Everyone has trouble imagining that. And yet it does happen. And you have those core characteristics. So
Chris Savage? Chris
definitely does.
I'm like, me?
Sylvie's been moved by this.
I'm like, that's it. I have a business.
To be fair,
funny.
it is something post our process and our decision to invest that we have this conversation, because those attributes we saw in those very exceptional unicorns, or whatever is the right term for them, they're the same attributes that help us select every single time.
I love that you have that conversation with people and you do it after you've decided, because I remember the feeling of the early days of being like, can I even manage a business that has 10 people in it?
Yeah.
And then we hit 10. I was like, why are we able to do 15? You're just like asking yourself these like really basic, and it's hard to imagine that it's going to be hundreds of people or thousands of people. And
I go a step further, Chris. I'm sorry to interrupt, but I think what's hard for people to understand about founders is they believe enough to do it, and then they have imposter syndrome the entire time.
Yeah.
So look, you wouldn't start the company if you didn't think you could manage 10 people. And yet you look around the room, maybe everything's virtual at so many companies these days, but back when we used to look around the room, like when I was a founder, I would count people at the team meeting as we were scaling up and be like, this is crazy. Like we got 43 people here. Like what? This is nuts, right? And 43 people, I think, to the outsider who hasn't done this and has heard these extraordinary stories, doesn't sound like a lot.
Yeah, totally.
But to your imposter syndrome,
it sounds like
you're
a
sitting
lot.
there being like, I am so in over my head that this is crazy. While turning around to anyone who would say that to you, that you're in over your head, and be like, screw you, I can do this.
Yeah.
Are founders better at faking the fact that they have imposter syndrome?
So here's what I think. I think everyone has imposter syndrome, or you're a sociopath, right? It's one of the two. But the question is magnitude, right? The question is magnitude. And I think founders have it, and it can be very debilitating, even very successful founders, but they're propelled forward by the things that help validate them. And I think the problem is they're often propelled forward by the vanity things that validate them versus the right things that validate them. And that can be a problem. So if your true north is always your customer and the validation of your customer, I think you get through a lot of those fears. I actually think the vanity stuff actually ultimately creates more imposter syndrome, because at some point you realize that person who invested a lot of money in you, they don't actually know. And by the way, at some point they start questioning their own investment, and you feel that, and it freaks you out completely. And then you're like, actually, they don't know, right? And what's interesting is when you start getting that questioning, but you're seeing what you want to see happen with your customer, you're very comfortable telling that investor, I know you're freaking out right now, but you're not seeing what I'm seeing.
It's funny you say that. That specific thing, I think, is it. Which is like when you see, like, you have a vision for something or you figure something out and you actually get customers using it or doing something differently, you don't need that many customers to be using the new thing to actually confirm for yourself, like, that this can work. And it does. When you don't have that, that is very hard. But like when you do, I think it is much easier to manage that.
I think like confirmation bias and optimism certainly lead founders to find validation in a lot of things that ultimately later they say, that didn't really work that well. But I think it's that heat-sinking missile to studying that and finding that is like the key characteristic to winning and overcoming all this imposter syndrome.
Pulling back the curtain. Pulling back
Pulling
the
it right
old
back.
curtain.
And let's go back to like, you're referencing vanity metrics, like raising money, stuff like that. Like, let's talk about, I mean, I know you're excited about this. So you've talked a lot about it, but like, Over-capitalization. What is that for people who don't know? Like, what does it mean to be over-capitalized? And how does it happen?
So I want to first address for every founder that is sitting around being like, why is this guy talking about this? Because like, I'm just desperate to find the capital I need. And like, we are barely surviving and we need money. And this guy's talking about over-capitalization. It seems quite insensitive. What I want to tell you is once you find something that's working and you're able to show that to people, in order to become interesting to anybody, you will very quickly become interesting to many folks. Capital has a way of finding heat. There's a very good investor who actually said that VCs are either truffle hunters or heat seekers. And I would say 97% of VCs are heat seekers. So the second there's heat around a company, an opportunity, VCs rush in. And when you've been struggling to find anyone who will pay you any attention and not just reject you, it is so awesome a feeling and so helpful in some ways to have everyone rushing in. The problem is once everyone starts rushing in, a lot of bad mistakes get made, right? A lot of problems start. And so founders just need to be very thoughtful. And the right way to think about it, I think, is if this was all your own money, how fast would it make sense for you to invest it, right? If it was only your own money, and then being careful not to get into this VC trick, this VC mindset twofold. One, that money solves problems. It doesn't. Money has no insights. We can talk about that in more depth if you want. When we say that, what do we mean? That's one part of it. And two is this money machine that VCs want you to get on, that where you always need to go back and raise more. And you'd say, well, why do they really want to addict you to the drug? What's that all about? And what it's about, maybe about them buying more and more of your company. Usually it's less about that and more about the validation they want. And this is something hard for most people to understand, but VCs, it's a very long road to exit values. And so VCs are very interested in short-term markups that help validate what they do for a living. So they can go to their investor and say, you see, we're marked up 3 times, 5 times. These days, it's more like 1.3 times or whatever. Things are going very slowly. And particularly when it's going slowly, they're looking for that false validation, that vanity metric. And so you needing more money that they can go potentially help upsell at a higher price helps them. It helps them with their own internal partners in politics, and it helps them with their investors.
Do you think that's because they have imposter syndrome too?
I think it's because they're in the business of raising money, and most VCs will say they're in the business of helping entrepreneurs, but really most VCs are in the business of raising money. And even if you're not, you're in the business of helping entrepreneurs, you still need enough capital to go do that.
Yeah.
And because you need to be selling, VCs are constantly trying to find ways to better sell what they have to investors.
Yeah, it makes sense.
And so this helps sell, right? It's a story for every entrepreneur who thinks it's easier to hire people because they can say how much they raised and how high the price was. It's the same thing. VCs think they can raise more money because they can say, this company I was invested in, a great investor followed me at 3x the value, and it's a killer business, even though it's burning way too much money at way too high a price, and it likely isn't going to work out. Nobody's thinking about that. They feel validated by that interim financing value.
Okay, so then we're talking, there's an entrepreneur, they've got a lot of heat, or they've got a lot of truffles. There's like a lot of folks coming in.
The truffle thing's like a different thing, but yeah, keep
I
going.
know, I put them together. They have a lot of hot truffles.
Hot truffles.
Delicious.
Trending.
Hot truffles.
Trending right
They're being
now.
shaved on top of,
To me, the truffle thing is the substance. I don't actually like truffles, but putting that aside, that's like the substance thing, right? Like we talk about build on substance.
Yes.
That's what you have, Chris. You have truffles. And the thing about truffles is, for sure, truffle hunters, they're the leaders. They're the ones who will identify things uniquely and get excited. The heat seekers, they're followers, and that's almost everybody in our industry.
I like how you keep saying heat sinker. It's a Freudian
Sinkers,
slip there.
Seekers. Yeah, exactly.
Yeah.
That is good. But so companies in the spot that they're fortunate enough to like probably raise a seed round, or they're moving, they get traction. Now they it looks like they have product market fit. They've got heat now, and lots of people can start coming in, and they start raising too much money. Like, we don't hear about this that much. So like, what does it really look like?
Totally. So when companies fail that had early traction, it is almost always because the equation of how they invested in their business was bad. And the VC incentives drive that equation. But let's talk about why from the entrepreneur standpoint. It starts with entrepreneurs are incredibly ambitious. You cannot build a great company without being incredibly ambitious. And when you're incredibly ambitious, you assume that if you hit the gas, it's going to work. And if you have the ability to aggressively hit the gas, it's really, really hard not to. So here's what I try to explain to people. Venture capital is not what people think it is. It's not magic pixie dust. It has no insights at all. The only thing it is, I wrote this piece called The Two Laws of Startup Physics. So here's what venture capital is as a physical property to startups. It is a compounder of whatever it is you have. So if you have a positive value formula, we all think compounding is good. We all learned in school compounding is good. Compounding can be very powerful. You compound at 20% a year over 20 years, you have some astronomical number of anything you started with, right? But you don't always compound positive value formulas. It's true also in bank accounts, right? Or in investing. You could have compounding negative values. And anyone who's looked at compounding negative values, they're really scary. You move towards zero extremely quickly in compounding negative values. Almost all of venture capital is compounding negative values for a few reasons. But that's almost our entire industry. So people get close to a positive value formula, right? Where you put $1 in and you think you're going to get $2 out, or maybe what it looks a little more like is you put $1 in, you get $1 and a penny out. And then you're like, great, we have a positive value formula. Let's go crazy. And you start aggressively putting money in. Now you get into law number 2. So you by the way, a lot of formulas look close to being positive value formulas. They're like 97 cents for every dollar you put in. But as you scale up, it doesn't improve. It goes the other way. So this is the other problem is people talk in business about economies of scale. But I would say mostly in technology companies, we have diseconomies of scale. And I could talk about why. But the implication is there is always a diminishing return to every additional dollar you put in. So it might be you have a positive value formula, put $1 in, whatever, you get $1.10 out at $100,000 a month of investing in your business. Can you do that at $1 million a month of investing in your business? The formula is never the same and it doesn't improve. There's a whole bunch of reasons. Anyone who's bought digital marketing knows that there's lower hanging fruit, and then over time you got to go to higher hanging fruit. Anyone who's expanded a sales force.
Yeah, you get the most interested people first, right? Like you're capturing the most interested customers first, and they're like going to convert better. They're going to pay more probably. They understand the problem, and the further you get away, the less they know, the harder it is to reach, the harder it is to get them to pay attention, therefore often more expensive or
if you expand your initial customer profile, usually you have a less valuable customer and a less willing to purchase customer, and it costs more. If you double your sales force, you start off by hiring the 5 best salespeople you've ever met, and they're amazing. And now you don't have 5 more of the best people you've ever met. So you start trying to recruit, and you get 5 worse people than the people you had before. And that's true at going 5 to 10, and it's true at going from 50 to 100, right? Your customer success organization at first pulls from the engineering team and is getting incredible feedback and response. And over time, it tries to scale up, and it's not as effective, and customers aren't as satisfied. So there are numerous reasons. The Mythical Man Month in engineering is completely based on this principle, right? Yeah. The additional engineer is less effective than the previous engineer. Each product feature you bring out is less likely to be impactful. This is on average. It's not to say you don't ever tap a vein that's really great, but it's less likely to be really like, let's look at Microsoft Office today. What is the likelihood that the next product feature that Word comes out with is going to somehow be game changing from the last one? Maybe AI changes that. We could have an interesting conversation about that. But generally speaking, the answer is not so much. And if you look at Apple Intelligence, I don't think most people think the billionth Apple iOS feature that just came out is particularly that much more valuable than the previous one. So
that's our biggest complaint with it right now.
That's right. So these are the diseconomies. So if you're not really thoughtful and you don't think of it really sophisticated, like how much of your own money would you invest, you start scaling up because you're excited and you finally feel validated. You have this wild ambition, and then it doesn't work, right? And the problem is it's very hard to admit to yourself and to others when you're in scale-up mode that it's not working. You just think you'll keep fixing it on the fly. It doesn't work that way. So you either need to backtrack and really go fix it, which is very hard to admit or usually happens way too late. And then the other thing that happens with capital, if you haven't been in this position as a founder, it may seem mysterious or surprising, but whatever amount of capital you raise, most founders divide that by either 18 or 24 months, and that becomes their burn rate, inevitably, almost every time, right? And so you have your ambition, you're going as fast as you can, you're not judging the burn rate based on what you're proving. You're judging the burn rate based on a formula that comes out of whatever venture capital round you raised. You're raising more money than you should have because there's a lot of capital heat seeking. Sylvie's catching me again.
Yeah, seeking and sinking.
And so this is the formula by which venture capital is basically blowing it for entrepreneurs. And then you get one more element that we didn't even get into, which is all of a sudden you have VCs who have raised funds that are so big that they start saying, well, I'm not interested in unicorns anymore, right? I need decacorns, which is crazy because there are very, very few of those ever. And for the founder, I say, like, think of it as the VC just said to you, you may think it's super compelling. You're like, I want to be a decacorn. Who doesn't want to be? But the VC just said to you, you're a baby and I'm going to inject steroids in you and see if you become Olympian. And if you don't and it ruin your entire life, it's really not my problem. I don't care. I'm going to do this a handful of times and one of them will work out and you are collateral damage to my business model. And I think that's tragic, honestly. I think that is very disruptive to entrepreneurs' lives, to our ecosystem, particularly because it is really hard to tell in the early days of a startup what has the potential to be a decacorn or not. You know, I was on the board of the Trade Desk. I wrote the first term sheet. I was on the board for 7 years past the IPO. People don't know it's roughly a $50-60 billion company, only burned $7 million before it went public. But for the first 4 years, one of the reasons we weren't eager to raise that much money was Jeff Green kept saying, I don't really know if this can become more than a few $100 million in market cap. So that is one of the biggest outcomes in the last 15 years. It is worth $50+ billion. So it's one of the very, very few. And it was never obvious to any VC or even the founder that it could be a multi-billion-dollar company. And yet the number of things that we have heard people say, well, this thing is so huge, it's going to be a massive Magic Leap, or name the companies, right? WeWork, all fiction. A fiction of a problematic industry that really puts hype ahead of validation.
So how should entrepreneurs avoid, if you're lucky enough that you get onto something and you actually can raise capital, like how should you avoid this issue? Can they avoid it?
Yeah, we give out stickers when we invest in companies. We send them stickers that say things like capital has no insights, caution, used with care. It's got skull and bones on it, danger, toxic. You have to think of it as, this is how I describe it. There are no adults. People think they're investors or they're adults. They are not. You are the only adult. And that seems super weird because very often the investor's older than the entrepreneur or whatnot. That makes no difference. You are the only one who really, truly cares about the many possible outcomes for your business that do not include very specific, extraordinary, outlier, rare outcomes. And you don't want to be anyone's collateral damage. So you really need to navigate that in the smartest possible way. And sometimes that means doing things that your bros will tell you are wrong, or a lot of the industry conventional wisdom will tell you are wrong, like, accepting not the highest valuation, taking in not the most money, burning carefully until you get the right validation, not getting caught up in the machine that feels so validating in the moment. Like most entrepreneurs were top students. They're good at winning games. And the game they play is fundraising. It's not a good game to play. The game you should be playing is making your customers happy and showing a business model around that and a go-to-market that works for that and investing in that as quickly as makes sense for what you can validate. And people challenge me. They say, Eric, you talk so much about capital efficiency and one of your best companies ever was Uber. And I would say Uber, this sounds crazy, but it was a capital efficient business. Why do I say that? Well, all of its early cohorts, markets, accelerated incredibly quickly and had incredible contribution margin in a very short period of time. So if you have all your early markets working and there's a speed to market early mover that matters, a network effect, and you have a decision, do we do 10 new markets this year or 40? With that level of validation, it makes sense to do 40. If all of a sudden you start to see something change, you might start pulling back. But like you've seen all these markets do the same thing, right? That is actually maybe until China, where some things looked really different. There were some different geographies maybe, but generally speaking, that is actually what I mean by capital efficiency. I'm an investor. I have no problem with intelligent investing. If you can put $1 in a machine and get 3 out, go do that and scale that as intelligently as you can, as far as that will work. But at the point you can't, people think I'm talking about profitability. I know you like profitability, Chris. But my view of profitability is if it's costing you genuine high quality growth, it may not be the right answer. It's not necessarily about profitability. It's about smart investing. And most of what happens in our industry is not, for the entrepreneur, is not smart investing.
Yes. Totally agree. And like, I think it's interesting the way you put the piece of like that the entrepreneur is the adult. Because the way I've thought about it is like you are the expert on your business, even though you might think you have other experts around. But like you're the only person who is the actual expert. And so it's your job to decide which advice to take. And
you're the only expert. You're also the only real fiduciary.
Yeah.
There is no other fiduciary. When you think of fiduciary as being like the trustee for smart governance of delivering on commitments to your employees, to your customers, to yourself, and your other equity holders, you're the only real, people on your board, so they have a certain amount of governance responsibility, including, by the way, there may be a moment, which hurts a lot, where their governance responsibility might even be to bring in a CEO.
Yeah.
But usually up until that point, which hopefully is not the outcome, their governance, they're not doing much governance. You're the governance.
Yeah, I love that. Okay. I know you said this, but I'd love to kind of get the question in there in a different way, which is like, so when someone should be raising more, what does that look like when it's like, it's actually a healthy time that you should be evaluating, hey, maybe I actually do need more funding?
All right, Chris, you can cut this part if you don't like it, but I'd like you to tell your story for a moment because I think I can use it as a very good example. I'd love for you to tell your story about the $3 million in EBITDA and when you had $10 million in revenue, because I love this story. I think it's a very powerful counterexample to what our industry does. So I'd love for you to share that anecdote if you're willing, so I can then talk about what it means for entrepreneurs, in my opinion.
Yeah. So basically we hit 10 million in revenue and we had 3 million in EBITDA. And everyone I talked to was like, what are you guys doing? Like, you guys are idiots. Like we were growing very quickly. Or I felt like it was very quickly. I thought we were successful because we were profitable. And so I was really proud, right? Like we hadn't raised that much money to get to this moment. And instead, like we're in this moment and everyone I talked to was like, you're an idiot. Like you and Brendan, like
go faster.
Go faster. And so we tried to go faster and we hired really aggressively. And we added a lot of other channels and other programs and other things. And as we added those things on, I think from an external perspective, there was more validation, right? Like I would go to events and people would be like, what's happening? Like, oh, you won't believe it. We just had 60 people and, we have this program. And they're like, oh, it's so awesome. So great. And like, I would tell them about all these other things we're doing. Like, oh yeah, I saw you have this new program. And I saw you have this agency thing. And so I was getting a lot of positive feedback, but then the on the ground reality was like, we were distracting ourselves and we had like zombie projects and things that were going where there wasn't enough careful planning or there wasn't the right person on it. And a lot of stuff wasn't working. And so it wasn't helping our growth. In fact, our growth was hurting in this exact moment. And it really started to suck. And so it wasn't until we got to the moment of like potentially selling the business and then doing the buyback that caused us to realize like, hey, actually, maybe we can fix this. And maybe fixing it for us is being profitable, because if we're profitable, then we can be long-term focused and we'll really run it like it's our business. That's the thing I think that's similar to what you're talking about, is like there was a moment when I think we weren't treating it like our own money exactly.
Right.
And then when we said we're going to do this debt funded buyback, we're going to go on the other side, it was like, no, this is like, we're taking care of all the other stakeholders. Like if this screws up, it's us. It's me and Brendan that feel the pain. And it made it much easier to figure out what to invest in. And then of course, like it all worked.
So here's what I think is so interesting about that story. First, I applaud you. That's awesome. You've built this amazing business and you did it in this really capital efficient way. But the lesson that I think is most interesting for entrepreneurs is you had this very well instrumented business. You had a $10 million business and it had $3 million in EBITDA. And you had trouble figuring out how to invest that $3 million in EBITDA in improving your business.
Yeah.
We have all these companies that have $3 million in revenue and raise $10 million in cash. And now they're expected to be intelligent about how to invest that $10 million in growing their business. So you should have been way more informed about what mattered to your customers and what was possible at 10 million revenue than somebody who's at 3.
Yeah.
And 3 million in cash relative to 10 million in revenue should be much more clear how to invest. And yet most founders get the opposite scenario, and then they don't understand why it feels like they're pushing a rope, and they can't figure out how to get what they wanted out of that investment. And yet they're so trapped by, you play the game. You say, okay, we've got 10 million. We're at a $3 million run rate. We're going to double or triple this year, we believe, right? And we're going to divide by 24, right? So we're going to start burning, what is that, $400,000 a month, right, to invest in the business. And so you start burning that. And then you're not getting the 2 to 3x growth. You're getting growth, but you're not getting nearly that level of growth that justified this burn rate. And by the way, maybe you divide it by 18 or 20 or something like that, so it's even higher burn rate. And now, how long do you go before you start to admit it's not working? You start rationalizing, well, maybe
it's
if
so
we make
easy
this change or that change, or, oh, it looks close. Maybe we'll figure out this, or we just have the wrong head of sales. Keep the sales force, just change out the head of sales, right? And you come up with all of these different things until you're almost out of money. And now you got a huge problem because you were supposed to be 6 to 9 million in revenue at the end of that year, and you're really at 5 or you're at 4.5, and you're burning $5 million a year, and you're almost out of money. And who's going to invest in you now? And this is the problem, was the capital.
Yeah, that makes perfect sense. I think there's another thing in there too, which is over what time period? Because you're talking about the 18 to 24 months. And what that basically means is you green light a strategy and you go do it. And now new people are building something new, and you can't build it in a month. It's going to take 6 months at the least. And then they finally get to market, and then they have to market. They have to be able to find it. And then usually there's a small number of people using it at first. And it's is the signal good or not? Kind of what you're talking about before, is this confirmation bias and actually this isn't good, or is it actually really good? And then you have to understand these other customer problems, which just take time. And I think it's just very hard to predict how long that takes. And so a lot of times the funding is if you actually had 4 years instead of 2 years to figure it out, you would.
Yes.
But instead you do it for really 18 months, and then you have to stop, or you have to do some Hail Mary, and the Hail Mary doesn't work, when actually if you just kept iterating, it would, And
then you have
it's kind of tragic.
Totally. And you have all these people around you at the table who are saying, well, we invested because we believe that strategy and we want to upsell it. And you got to make that work. Go. We didn't give you 60 months of capital. Go as quickly as you can. Because that's the game we're playing. And I think that is really unfortunate. And I don't think entrepreneurs should get sucked into that. I tell our founders when they raise their next round, I say, okay, think of it as you're going to burn this in 18 to 36 months. 18 is going to be, if it's working really, really well, you'll accelerate into it, and you'll have no problem in 12 months, 15 months, starting to go out and do a raise and have more capital in 18 months.
Yeah.
But that's only if it's working magically. If it's not working magically, you want 36 months. You might even want more than 36 months. But start off with this mindset that this has to last you at least 3 years, unless you're seeing the evidence that's real that you can invest more aggressively. And even that scale up, be very deliberate about that scale up, unless again it's so obvious that your customer is ripping it out of you that it should be. Then it's just obvious.
Okay, I want to switch tact here because we're running low on time. But there's a couple of things I want to make sure we hit. I talk to lots of friends in tech all the time, and it's been hard. Is the truth for a lot of folks. It felt not even just post-pandemic, but even the normal world pre-COVID doesn't seem like the world we're in now today. There's less open software engineering positions today than there were in 2019, which is a mind-blowing number in my opinion. What do you think companies that have been around, some of the companies that you would have invested in, and then maybe they did go raise a Series A or Series B, but now they're entered into this hard environment? What do you think companies should be doing in this hard environment today to get through it, to get out of it?
I think so. The thing we talk about is you have to be building genuine substance, right? It is not about hype. It's not about telling a story that will satisfy somebody else. It is about demonstrating that you are building real substance in your business every single day. You're compounding something that really matters to your customers, to your industry, and creating consistent value with what you're investing in your business. So the first question I'd ask somebody who's struggling through this time is, does your investment pace in your business reflect compounding substance or not? And if it doesn't, the fewer people on your team focus on finding that formula, probably the better. not the more people, and not the faster you're investing, the slower you're investing. And so sometimes you got to get back to the basics. You know, if the house has got rot through the whole house, you might have to go down to the studs, right? Like, and it's really hard. I mean, it's painful. It's why people avoid it, right? Is you just always want to believe the most positive case. But this is the problem with getting ahead of the substance of your business. And once you do, it's really hard to go back. It's not impossible. I've seen people do it, but it's really, really hard. I had a company a few years ago that was running out of money. They had a few $100,000 left, and they had a few $100,000 in ARR. And the guy he just didn't think he could raise more money at that point. And so he was thinking about shutting it down or selling it in a fire sale. And he ended up just cutting down to himself. He happened to be an engineer, and just start working on improving the product. And then he started finding like little tiny bits of traction, scratching away at it, ended up hiring a couple people and then a few more. And now he's got a 2 million ARR, and he's barely spent any money of the capital he had getting there. And you might say, well, it's not that exciting, 2 million ARR. And I would say, like, from where he was, I mean, it takes enormous resilience. But from where he was, it's quite astonishing. But what's for sure to me is, had he not been willing to cut down to the bone, it would have gone under. So you might say, that's okay. It doesn't really matter. You just go at it again. I don't know. I think some of these businesses can turn into something real. I think actually, if he accelerates now with what he's learned at the right pace, I don't want to say like he should invest, $20 million in the business tomorrow. I think he's got a shot at building a really good business. Some of this is, do you really have a passion for what you're doing, whether or not it's going well, right? I think that's a key element is if you have a passion, even when it's hard, you're much more likely to be resilient through the tough parts. And almost every business goes through tough parts. You can't expect to build a business only in up cycles. It doesn't happen.
I think that's very hard for people to realize. What you just said there, like to actually have passion even when it's hard is like, if you can do that, you basically get to stay on the problem. And if it's compounding positively, compound it, you definitely get to increase your learning. You get to build your gut, right? And like understand hopefully how to get to like a higher hit rate. But if you can't get through it, I hope that's what happens at this moment. Like, will it get better at some point? Absolutely. And I think there's going to be a lot of companies that actually learned how to build real value in this period of time.
I think if you get out of hype mode and you get really focused on getting back to a place where all you're doing is compounding, even if it's slowly, positive value in your business, you will find your way ultimately to a good outcome. It's very hard to do, so it's very easy to say. But even with our LPs, we had our LP meeting last week, our limited partner meeting, and we were talking about how many of our companies right now in our industry, companies, we call them stunted adolescents, right? And what we mean is, they had enough traction by 2020, 2021 when ZERP happened and there was tons of money out there that a ton of money rushed in. And then they built really bad economic machines, right? Really, really dumb ones that were all about hype and vanity. And it will take those companies, 3 to 4 years if they have that endurance and they can find their way through it to get back to clearly compounding value again. But if they have the resiliency to do it, they will actually become good companies.
Yeah.
Right. And some will fold because the founders will be like, it was fun when it was fun and it's not fun anymore.
Yeah. Okay. This has been an amazing conversation. I just have a few more quick questions.
Yep.
So we'll just go right to them. What's your go-to karaoke song?
Geez, I'm not much of a singer, honestly, but I would go with Don't Stop Believing.
Perfect.
Oh, yeah.
That's perfect.
That is perfect.
What's a movie that you could watch again and again?
I'm a huge Field of Dreams fan.
Field of Dreams.
Once again, don't stop believing. If you build it.
Don't stop believing. They will come. What's the best book you've read this year?
Oh, man. I didn't expect you to say this year. I get this question a lot.
Oh,
but I'm going to throw out, maybe not this year, but I thought Jerry Colonna's Reboot was like, it was incredible unpacking of how hard it is, the journey of being a founder emotionally, or at least it connected to me so deeply on that level, and how much we all really need to talk about like how we support the mental health of founders through what is such a really extraordinary, intense line of work, right? And founders are held up as these heroes, and that you kind of like really focus on the hero journey part of it. And people like are excited to be part of that hero journey. It's like the hero journey of a general in war kind of thing, and war metaphors are a little too dangerous here too. But like without leaving out all of the really, really difficult strain and doubt and fear. And I just thought Jerry captured so much of that so beautifully. So I found that to be like very powerful book related to what I do.
That's awesome. I've read it and loved it, but I had forgotten about it, so it's a good reminder. And here's my last rapid fire question. What's your dream job other than your current one?
Ooh. You know, I don't actually, I can't get very specific, but I go very high level.
Okay.
You know, I do see a lot of positive social benefit and impact in the work we do as VCs. I think there's a lot of bad stuff too, but at least the way we try to do it, I do believe in the social impact. But I would love if you said, what would my dream job be if I wasn't doing this? I think leading an organization that was just like incredibly powerfully enabling in people's lives would be very inspiring. I recently joined the board of the YMCA of Greater Boston, and I love the guy who runs it. David Shapiro is just amazing. And I just think like every day they're having so much impact. People think of like gym and swim, but actually they run the biggest food security program in Boston. They run the biggest early childhood education program in Boston. So there's something about like spending your every day waking up, serving the most important needs of your customer. It's so admirable. And like, if you said, if I wasn't doing what I was doing, what would I wish I was doing? It would be something like that.
Eric, thank you so much for coming on the show. Thank you for breaking this process down and helping people understand. I mean, it's like I love your approach here. Where can people connect with you to like follow your story, learn more, pitch you, what have you?
I'm E. Paley on Twitter, or X, I should say, now that it's been terribly corrupted. And I blog at epaley.org, and we're at Founder Collective. So come take a look at what we do online, and feel free to be in touch.
Awesome. Thanks, Eric.
All right. Pleasure.
So you can see why I wanted Eric on.
Oh, yeah. He broke down venture capital like physics.
Yeah.
Like, that was it.
Yeah.
We learned the physics of startups.
Yes. And I think like he's talking about something that most people don't want to talk about actually. And like, working against himself in some ways, like in the short term, right? Like instead of marking the company up, companies raising more money, like it's actually being more patient and not having the short term hits to get the long-term gain of like building the better companies. And obviously resonates so deeply with me because of like our experience building Wistia and kind of finding our way to efficiency and building the conviction around that. But I think there's a lot of stuff in there that I didn't know when we were going through this, and still is like really good reminders. I think the point of like, you put $1 in, what are you actually getting out? And if you're getting like a penny out, like it's very possible that equation is going to flip to be negative. Or are you even getting $1 and a penny out? Like,
right.
And there's that balance of how optimistic do you need to be to believe and build the future? Like you obviously get to be optimistic to create a future that doesn't exist, but then how realistic can you be about how it's actually going?
Yeah. This felt like cautious optimism, which is more my language.
Yeah. You like that.
I like that. I'm not like a blind optimist. I am like, okay, baby steps, cautiously optimistic. I mean, and he said something that we talk about on the show all the time with other founders, with other marketers, with other product developers, which is that like, if your true north is your customer, like really, that's a huge piece of the puzzle.
Yes. And I think that is like, it's very, at the beginning, you basically have to do that to get anything going. Like you have to be close to the customer. We've talked about this a lot before on the show, but like the thing that people struggle with is the second you start scaling, what stuff are you giving up to scale? And do you get too far from the customer?
Do you get too far?
And it's so easy to happen. And it feels like success in many ways because like, oh, now I don't need to be the person doing this. When the truth is you basically always have to stay close. You just have to find different ways of staying close. And it does become very simple though, I think, which is like, he basically is talking about that thing across all this experience. But if you can actually say like, I'm very close to customers and I can show them new things that we've done and I can see, do they actually use them? Do they actually like them? Does it actually help them?
Right.
If you can get an honest assessment of that, you can tell if things are going to work or not. Like you can tell if you should do more of it or not.
Yeah. The idea is simple and the execution of it, because you now have all these other distractions, that's what makes it hard.
Yes, it's the distractions. I think it's the time period. Like, are you willing to understand how long it takes for things to really happen? And when I say you, I mean me. Like, it's like, have I been willing enough in many cases to stick with something long enough that you can actually say, like, how many shots on goal do you get? 4 on a product? 5, 10? Like, it just takes so many iterations. And I do, to bring it back, like, we've talked so much about the pace of improvement at Wistia and how we've been able to grow more quickly. And like, it aligns very closely to what's worked incredibly well for us, which is like, you don't always know what's going to work. So if you can shorten the time period between when you learn, that actually is what drives improvement. It's the pace of improvement over time that actually adds up to much more learning and then a much better result. But like, it's getting the input correct, right? And I think it's so easy to lose it. It's so easy not to be close to it. And then it's very, very hard if that happens.
Tortoise in the hare.
Tortoise in the hare, or like, it's not about hacks and it's not about the Hail Marys. It's all incremental, which is like, doesn't sound very sexy to be like, it's just all incremental growth. Yeah. But actually, I think if you're in solving the right problems that are big enough, that actually is what it looks like.
I couldn't agree more.
Neither could I. And if you couldn't agree more, just rate and review us wherever you listen to the podcast, wherever you watch it. We really appreciate it. If you are wanting to connect with Sylvie and I, you can find us on LinkedIn. Comment on posts on LinkedIn. Send us messages. Ask us questions. Suggest guests. We've had a lot of amazing guests. We have a lot more amazing guests coming soon. But some of my favorites are when someone says, hey, I think this person would be a great fit. That is often the case. And I think that is it until next time. Is that right?
That's right. I don't know why I keep talking like a show announcer, but there you have it.
Because you basically are. Okay. Bye, Sylvie. Bye, everybody.